Welcome everybody. Welcome on how to find the best dividend paying stocks paying 3% or better or more. My name is Russell Markham and I'll just transition myself here on the fancy camera setup here, and let's effectively do this. I'll just move it across, so bear with me. Here we go. I've just got to transition my screen, and I think you can now effectively see my screen here. Okay, so my name is Russell Markham. I'm the Director of Education for VectorVest Asia Pacific, and what a pleasure it is to have so many of you along today via the YouTube live stream. So we are going to record this, and the recording, I believe, will also be made available. So great to have you along today. Let's get into it. So how do we find the best dividend paying stocks? 3% or more. All right, so let's do this. Let's transition myself again, and you're now effectively seeing this main screen here. Okay, so the first thing I want to talk about here is we need to find consistent dividend paying stocks. Now, the way you find consistent dividend paying stocks is you need to go and find stocks that have consistently paid those dividends, right? Easier said than done. There's a couple of key ones out there in Australia where they have consistently done this over the years, and let's do this. I'll transition. You can see me here as well, the amazing software we've got here to effectively do this. So how do we do it? So you might want to jot this down and put it into your link there, into your browser when you're searching in Google, for example. Type in why dividends matter plus, and type in any one of these names here, Mortimer or Matthew Page, Dr. Ian Mortimer or Matthew Page. You can't miss it. It's a free report on the internet done by the Guinness Atkinson Funds series there, okay? Now, that report, what it noted there is it noted that history has shown that companies growing their dividends year in and year out over the last 30 years in the US, so in this case it was US because it was a lot of research done on it. Similar findings have taken place in Australia, not as much research, of course. So 30 plus years in the US have found that companies that consistently, pay their dividends are companies that have outperformed the market. Non-dividend payers or dividend cutters have not outperformed the market. All right, so this was the research that Mortimer and Page had done, Dr. Mortimer and Page. So this is the reason why we want to find those top dividend paying stocks. Now, the whole point for this Hot Topics of Interest series, this being the first hot topic of interest here, to find those top dividend paying stocks. Well, okay, so we set the scene as to why it's important to find the dividends, but let's get about and find them. So this then brings me to the key part of this live stream today, and that is how do we go about and find those top dividend paying stocks? Let's set out the definition firstly. So we all know there, if you're new to investing, a dividend is a distribution of a portion of a company's earnings to shareholders. Dividend yield is the amount of dividends paid out divided by the share price times 100. So it's just a percentage. What percentage of a company's price is being paid out in dividends, okay? Let's do this. If I said to you in Australia, let's list all of the dividend paying stocks of 3% or more, where the share price is 2% or more, or 2% or $2, should I say, $2 or more, and then find me those companies that have got the best combinations of fundamentals and technicals. So what do I mean by fundamentals? The best building blocks, best cash flows, been around a long time, management team deliver year in and year out on average, right? So those are the fundamentals. The technicals are basically, we've all programmed to understand technicals. If I show you a graph that's going up smoothly left to right, well, congratulations, you've just effectively identified good technicals, okay? If I show you a graph where it's all over the place, up and down, very volatile, then you'd say, no, I don't quite like the look of that pattern. And again, you've done technical analysis, you'd say the technicals are not that strong. And if you're seeing a graph falling heavily in price, you'd say that certainly would not be a company you'd be interested in. Okay, so we want those smooth left to right upward trending stocks. In addition, we then also want to make sure that we are finding those companies with good solid fundamentals behind them. Okay, so in VectorVest, all right, so in the VectorVest system, all right, and I'm just going to introduce you here today. You can take it a trial at the end of the live webcast here. If you want to trial out VectorVest for 30 days for $10, you can trial it out. But in the VectorVest system, I'm going to use the power of the dividend payers watch list. So you can see at the moment there are 62 as of the other day. I took a snapshot. 62 companies where the share price is at least $2 or better, where the dividend yield is at least 3% or better. All right, so I've just listed a handful. These are the top ones from a fundamental to technical perspective at the moment. But let me ask this question: which shares are best? Just because a company's paying a 3% or better dividend yield, so you see all the dividends here, you go, okay, 3% or better, but you buy it and then you go, oh, hang on, I'm getting my 3% dividend yield, but the share price lost 5 or 6%, so the net effect is I haven't actually made any money. I don't want that to happen to you. So which are the best? Not all dividend payers are the same. Which dividend payers are the most reliable? Which dividend payers are looking to grow their dividends year in and year out? Have you ever bought a dividend paying stock and then, a year later, it's like, oh, hang on, it's no longer 3% dividend. Oh, they've cut it. It's only paying a 1 and a bit % dividend. And you feel cheated. You go, well, I bought the stock to get a 3% yield and now it's only 1 odd %. How do you avoid that? I'm going to show you that today. All right, we need to make sure that we have the earnings to back their dividends. So do those dividend payers have sufficient earnings to back their dividends? If you don't have sufficient earnings, you can't meet or exceed dividend obligations. Okay, so in the dividend payers watch list here, all right, let's have a look. So we can see the price. So there are no penny stocks here. We know there must be at least $2 or better. And then we get to look at the dividends. All right, so you can see, this company here, Min Resources, $1.77 on average, 24 cents here for theirs. What's that, NRO Group Limited, 14 cents. So you're looking at this going, well, this one here doesn't look too much. Medicash only paying 14 cents. This one here also only 14 cents. But remember, your yield is the dividends divided by the share price times 100. Okay, so we look at the dividend and then we look at the dividend yield. There it is as a percentage. So all of a sudden, you look at the one that's paying 14 cents. Oh, hang on, but it's a $3 share. So that equates to 4% dividend yield. Oh, okay. So there you are. You're getting some very good yield. So again, I'll run my eye down here and I go, okay, some very attractive dividend yields here. I can afford to be picky. And yes, that's not a typo. That's an actual screenshot from VectorVest there, 11.4% for Fortescue Metals. And yes, last year to do double-digit dividend yield. It was one of the best dividend payers in Australia. All right, well, let's have a look here. Let's be fussy. All right, so I'll look for the ones where it's, in this particular case, below 4%. Why not? All right, so I can identify these and go, okay, well, look, Min Resources, 3.86, Medicash, 3.79, and Think Childcare, 3.88. I'd say to myself, well, hang on, and is there another one there? Yep, down the bottom, Evolution Mining. Well, relative to the other providers out there, very good dividends, but I'll sort of put a red line through you for now, at least flag it that you're not as good as some of the other dividend payers. All right, so move on a little bit more. So I sort of jot those down, go, okay, well, just not as good as the other ones. Now, here's the important part. Just because a company is looking to pay a high dividend, all right, so this is kind of what it's looking to pay. Does it mean, in this case, Fortescue Metals, does it mean that Fortescue Metals will pay 11.4%? That's the million-dollar question, right? Because if we didn't doubt it, if companies would say, well, there we go, I'm paying 11%, and they did it every time, we wouldn't have to worry about it. But unfortunately, what does tend to happen with some companies, not all, but some companies, what is being sort of offered initially sometimes can change. All right, circumstances change. There might be changes in the market conditions. There's all sorts of reasons. So we need to make sure that those dividends are nice and safe. So this is what we do in Australia. We look at this all-important dividend score here, dividend safety. It's on a scale of 0 to 99. And here's a little secret for Australia. 50 or better is a good, consistent and reliable dividend paying company on average. 60 or better is an excellent track record dividend paying company. All right, so if I have a look here, let's see, let's single out any low scores here. Ascent Group 42, it's just below 50, so not as reliable, say Min Resources at a whopping 82. And let's have a look here, there's a 48, not too bad, it's just below the 50 though nonetheless. And Think Childcare, Evolution Mining just scrapes through above the 50 mark, which is good. So you can see over here, these are excellent dividend paying companies from a reliability and a consistency perspective. So what we do at VectorVest is we go and look at the track record of those dividends. Where companies fall short, they're looking to pay a 4% dividend and then didn't end up paying a dividend, or cut the dividend to 3% or 2%, that effectively starts to tarnish the dividend safety calculation. And eventually, if a company falls short enough, it's going to start getting a lousy score. All right, now, these two here, Cent Group